How's it going, investors? I'm Ari and welcome to the channel. As always, we're going to be talking about value and dividend investing. So if that's you, then stick around. And if not, well, there's certainly someone somewhere out there for all of us, as they say. Anyhow, in today's video, I want to keep it pretty light and simple and just sharing with you a very quick update regarding my personal brokerage account, then get into a bit of a macro market update for all of us, and finally, just 5 dividend stocks that I think are worth loading up on as we speak. Oh, and that Tip Ranks Black Friday deal I mentioned last video, that's still on the table. It's in my description in a pinned comment. So take full advantage of that if you wish. And of course, before we dive in, go ahead, tap on that thumbs up button for me, as it greatly helps me out in growing this channel. If you haven't already joined me on the journey, you could do so by simply subscribing. I'd absolutely love to have each and every one of you on this journey with me. Now, investors, let's go ahead and dive right in. So after a shortened week last week, given it was Thanksgiving, there was not a whole lot going on in the market, and historically that's always been the case. A lower volume trading week, the week of Thanksgiving, but we did see some momentum building up this past week, whereas my personal account climbed to $104,600.83, which is great, but most importantly here for me is sharing the why behind it for all of you. So now, as I see it from where I stand, that momentum was really built and stemmed from the release of the Federal Reserve's FOMC meeting minutes being released to all of us, and us investors then getting this inside scoop on the Fed's plan of action regarding interest rate hikes come December. And diving even deeper into these minutes, they gave way to many Fed policymakers agreeing that it may soon be appropriate to slow the pace of interest rate hikes. This all essentially means that we could see a 50 basis point rate hike as opposed to a more aggressive 75 basis point rate hike like we've been seeing. Now, on top of all of that, we've had multiple data sets that seem to be revealing that our economic backdrop is in fact improving, which is also a great sign. This is all positive news for the market, but personally, I'm not entirely convinced just yet that we are in the clear. This then means that we should be prepared for anything, as the future is totally unpredictable. Therefore, I wanted to go ahead and break down 5 dividend stocks for us today that I personally am looking into and would certainly recommend to a friend or family member. So the first dividend stock I actually want to go ahead and break down is JP Morgan, ticker symbol JPM, which is not only the largest bank in the United States by assets totaling over $3.74 trillion, but it's also right up there ranked as one of the largest banks in the world with a market capitalization totaling over $400 billion. Now, it should not be too big of a surprise that JP Morgan, along with their industry peers, inevitably has been suffering from lower interest rates since the benchmark interest rate hit 0 back in March of 2020, which has only really created a buying opportunity for the opportunists out there. And of course, with JP Morgan's share price sliding down, remains down on the year by about 13%, trading for $136.48 per share. We're talking about a solid opportunity. Their PE ratio is coming in at 11.5. Now, I personally hold Bank of America, and I'm here to say that either of these two behemoth of banks are, in my opinion, worth a long-term investment. I'm selecting JP Morgan for today's video because, well, quite frankly, in the words of Jamie Dimon himself, the bank's balance sheet is truly just a fortress. And not to mention, I believe with the housing market as it is, JP Morgan is already there prepping itself to take full advantage by acquiring over $1 billion in single-family rentals, thus exploiting a lull in the home building, which is also just icing on the cake here for JP Morgan, as they're beginning to see revenue notch right back up. Now, from what will be, in my opinion, a prolonged period worth of higher interest rates, which do wonders for banks as they generate the vast majority of their revenues primarily by lending money and charging interest. Now, when it comes to investing with our current economic backdrop, companies that we invest in should really just have strong leadership along with clean balance sheets and a dominant brand name, to which JP Morgan checks out to me. And therefore, even if a recession is to hit and the Federal Reserve cannot avoid a harder landing, I'm very confident that JP Morgan will see through to the other side and come back even stronger. And smart money is there with me on this notion, which is why we can see plenty of hedge funds increasing their share counts and growing their positions with JP Morgan. I mean, this list just goes on and on. As for analysts, we see that growth lies ahead as well, with an average target share price coming up to $140.33 per share, equating to almost 3% worth of upside in the near term. But again, personally here, being long on these investments is where the real value comes in by collecting on their dividend, currently at a dividend yield of 2.96%. As for our second dividend stock of the day, it's been in my portfolio since the lows of 2020. And while it's rallied to some higher highs in 2021, well, the dismantled supply chains have only wreaked complete havoc on this healthcare leader. We're talking about Medtronic, ticker symbol MDT, which has really only made a name for itself since its founding back in 1949 with a single segment focus on medical devices, which is worth noting for all of us investors because it allows us to better understand why the company has not been performing so well as we speak. I mean, just think about this, having all your eggs in one basket as a medical tech titan. Now they are heavily reliant on, say, supply chains for semiconductors, whereas our Johnson & Johnson's, Cigna's or CVS's of the world, well, they all have multiple segments dealing in pharmaceuticals or elsewhere. So no wonder we see Medtronic hovering around $79 per share, down by about 24% on the year. Yet this should not be alarming to any of us, as Medtronic is a $105 billion market capitalized company that will likely remain in the position to continue to advance the medical world well into the future for decades to come. And with their PE ratio at just 20.2, that is certainly coming in at a juicier number here. Now, I do not want to mislead any of you guys. Medtronic is not going to be some 10x investment that if you invest in it today, you're probably actually just going to have to wait some period of time before you see this return. But we could see some upside potential here coming in at a share price of $89.07 per share, presenting us with over 12% worth of upside. And as for hedge funds, yes, of course, we see smart money with some skin in the game here, scooping up more shares worth of Medtronic, as well as what I would like to say is just a wise move for safety purposes. But let's talk about those dividends, shall we? Because as dividend investors investing into Medtronic, we get that reliable dividend, with Medtronic's dividend coming in at 3.18%. All right, guys, moving right along, we have dividend stock number 3. Now, I'm going to warn you, I've been harping on this one for a long moment or two, given it is just massively discounted, and where it's currently trading at, it's just too good to pass up. We have Stanley Black & Decker, ticker symbol SWK. Now, I don't want any of you getting upset because I keep talking about the same stocks. Well, guys, I have news for you here. I'm not here to entertain you. I have a mission to share stock opportunities that may fare you very well come your financial future. So this is where Stanley Black & Decker, to me, is just a no-brainer. Besides, it's not exactly fun to talk about the same stocks on my end, and investing, in the words of George Soros, if investing is entertaining, you're just having fun, you're probably not making any money. But I digress. Let's get into Stanley Black & Decker, as it's the world's largest tool manufacturer with top shelf brand names like DeWalt, Stanley, Craftsman, Paladin, and more. Stanley Black has been in business since 1843. They're not going to be disappearing anytime soon. They're rock solid, and I mean a rock solid business, especially as they supply the largest home improvement retailers. You know, like your Home Depots and Lowe's that everybody seems to be flocking to, at least within the dividend investment community. I personally say go right to the source. That's where the real gold is. So with that being said, Stanley Black has been leveled this year when it comes to their share price. It's down over 54% in the year, trading for just $82 per share, with a beautiful PE ratio coming in at just 9. So quite frankly, if you ask me, it is quite a steal. And what more evidence do we need than to see hedge fund after hedge fund also pouring millions of dollars into this position with Stanley Black & Decker? Of course, this opportunity is to be embraced now before our economic conditions get any better. We have DIY projects that I am certain just have been pushed aside as consumers reduce spending, on top of mortgage rates at higher levels, meaning new home sales and even new home construction is just down, leading revenue declines for Stanley Black & Decker. But as long-term investors, guys, the long-term investor is going to capitalize on a great opportunity like this one. I've personally added 20 shares of Stanley Black & Decker to my very own portfolio. As for analyst forecast, we have a price target here coming in at $85.25 per share. But if we just wait for that economic recovery and leave it at that, I mean, money is to be made. And until then, how about this dividend king just shelling out a 3.92% dividend yield to us all? As for this next stock, investors, I'm going to come clean right off the bat here. It is not a dividend stock. But before I lose you, hear me out. It is a stock that I think is as safe as some of these dividend kings and aristocrats that I talk about. And over the next 5 to 10 plus years is going to make every investor who capitalizes on this opportunity a very pretty penny. And moreover, it's a company I am more than confident you all use every single day, probably 100 plus times a day. I want to talk about Google, ticker symbol GOOG. Now, we all know that the tech sector took a massive beating over the course of the last couple of years, but if we just focus on Google, a company that leverages its search to drive a vast majority of revenue through the sales of advertising, Google slid over 32% and is now just trading for under $100 per share at $98.46 per share. Is this concerning for an investor like myself? Someone who seeks deep value? Absolutely not. Guys, we're talking about a $1.28 trillion market capitalized company. But for just a moment, guys, join me in the future where we are only advancing even more technologically and advancing into a digital era that I only foresee Google perfecting their ability to target consumers even more effectively to really just continue to dominate the world of advertising. Now, once an economic turnaround is well underway and we see less distressed businesses, it is going to be a given that they're going to come right back to marketing and advertising efforts and crawling back to Google for targeted advertising. Now, especially when it appears more and more traffic is even flowing to Google in the first place, as we can see when analyzing Google's domain website traffic. Now, as we speak, Google's PE ratio is also under 20 here at 19.5, where the price and PE ratio lower a few weeks ago when I bought into Google, yes. But right now, for the long-term investor, I still think it's an opportunity. And personally, I added 45 shares worth of Google to my own personal portfolio, making it just one of 3 non-paying dividend stocks in my portfolio. And let me tell you, I don't think I'm alone here. Hedge funds taking full advantage of the discounted stock opportunity with Google. I mean, we are talking again about millions being poured into Google from smart money across the board, not to mention analysts who are incredibly bullish on Google with the target share price coming up to $127.62 per share. That's over 29% worth of upside projected to come our way. And last but not least, guys, if you're not sold 100% on any of these stocks that I mentioned today or any other, just given the economic backdrop that we're currently living with, it totally makes sense, but it's also better to have time in the market than trying to time the market itself. So buy a slice of the entire pie by literally investing into a broad market index fund like Vanguard's Total Stock Market Index Fund, ticker symbol VTI. This allows investors to reap the benefits of small, mid, and large caps with a balanced mix of both growth and value investments, totaling over 4,000 stocks. Not to mention, it shells out a quarterly dividend here, averaging a 1.58% dividend yield. And it's just an investment, in my opinion, you can't go wrong with. Now, investors, that's it from JP Morgan to Medtronic, Stanley Black & Decker to Google, and the entire market with VTI. Those are my picks for you this week. I strongly encourage each and every one of you to look into them. If you see fit to do so, go ahead and invest into them. But I want to also remind you I'm not a financial advisor, so always do your due diligence following any of my videos. Now, before we actually get going, I do want you guys to know that your thoughts are appreciated on whether or not these stocks were solid investments or if they're in your portfolio, or better yet, guys, if you found any better investment opportunities out there for all of us. Go ahead, drop those comments down below. Again, you still have time to take advantage of TipRank's Black Friday deal. Yours truly went ahead to extend that sale. And finally, guys, I want to let you know that it's all about growing this channel right now. You help me, I help you. Tap on that thumbs up button to help me grow this channel. If you haven't already subscribed, go ahead and subscribe now. Till the next video, I will see you all there.